Did you know that the money you see when you look at your bank account doesn't actually exist? Yes, you heard that right. The money in bank accounts is not truly real. This is not an assumption. It is not a prediction. It is a description of reality itself. If tomorrow every account holder went to their bank and demanded their money, the system would collapse instantly, because in reality, that money simply does not exist. This is not a mistake. This is how the global financial system was deliberately designed. It is so old and so deeply embedded that we now accept it as normal. It even has a name: fractional reserve banking. The massive global debt, inflation across nations, and so-called wealth all stem from this exact reality. Once you understand how the system works, you will also understand why money, in truth, can never be fully kept. To understand how this system was built and where it began, we must travel back to a time before digital banking ever existed. In medieval Europe, money was physical, gold and silver. Wealth was measured by the coins and jewels in your chest. But carrying bags of gold was extremely dangerous, so people began leaving their precious metals with goldsmiths who owned secure vaults. In return, they received a receipt. As this system evolved, people realized something remarkable. Instead of retrieving their gold and paying with it, they could simply use the receipt itself to trade. After all, that piece of paper represented real value, and it was far easier to carry. This is where the great illusion that built the modern world was born. Over time, goldsmiths noticed that almost no one came to claim their gold at the same moment. Compared to their total number of clients, only a few people appeared on any given day. This meant that most of the gold in the vaults remained completely idle. The goldsmiths saw an opportunity. They no longer needed to issue receipts equal to the gold they actually held. After all, not everyone would demand it at once, so they began issuing more receipts than the gold they truly possessed. These extra receipts were lent out with interest, allowing them to profit from gold that did not even exist. As long as everyone did not demand their gold at the same time, no one would discover the truth. Money was being created out of nothing, and it worked. This was not just a clever side business for goldsmiths, it was a revolution in thinking. Once people began trusting paper claims as much as physical gold, money became detached from physical reality. This practice gave birth to banks. For banks, the trick was incredibly efficient. And with banks, it became institutionalized. And, of course, governments did not stay away. By the 17th century, states had fully embraced the system. When we look at the founding of the Bank of England in 1694, we see that it was not created for the public, but to cover the debts of the crown. Continuous wars had pushed the monarchy into bankruptcy. The central bank stepped in and lent the state far more than it actually held in reserves, charging interest in return. That debt was not repaid with war spoils, but with taxes collected from the people. Sounds familiar, doesn't it? Because this is exactly what modern governments still do today. They borrow money that does not truly exist and repay it with interest spread over years, using the taxes of future generations. The United States followed the same path. Early American banks issued banknotes convertible into gold, but they too discovered the hidden trick of the system. They could issue more banknotes than the gold they actually possessed, and they did. During times of panic, however, bank runs exposed the illusion. When crowds demanded their money, they discovered that it was not really there. Banks collapsed overnight. Yet instead of abandoning the system, governments strengthened it. Central banks were established as the ultimate backstop. The message was clear. Even if the money was not truly there, the public had to continue believing that it was. Now let's look at how this works today. Suppose you deposit $100 into a bank. You might believe that money simply sits there waiting for you. In reality, the bank keeps only a small portion as a reserve. In the past, this reserve ratio was about 10%. The bank would keep $10 and lend out $90. When that $90 was spent and deposited into another bank, that bank would keep $9 and lend out $81. This process repeated again and again. By the end of the cycle, your original $100 would have turned into nearly $1,000 circulating in the economy. Yet the key truth remains. Only the original $100 ever truly existed. Everything else was debt created out of nothing. If this shocks you, I have worse news. That system is already outdated. In the United States today, the reserve requirement is 0. Since March 2020, the Federal Reserve no longer requires banks to hold reserves against deposits. There is no longer a formal limit. With a theoretically infinite multiplier effect, deposited money can expand without a hard boundary. So what stops banks from lending infinitely? Capital and liquidity rules. These are defined under a global framework known as Basel, created by central bankers and regulators meeting at the Bank for International Settlements in Basel, Switzerland, the so-called central bank of central banks. These rules are not written by elected parliaments, but by unelected technocrats. Under this system, banks must hold enough capital to absorb potential losses. The rules are complex, but the essence is simple. If a bank wants to issue a risky $100 loan, it may need to set aside roughly $8 of its own capital. The more risk it takes, the more capital it must hold. Banks must also prove that they can survive short-term crises with sufficient liquid assets. But here is the real transformation. Banks no longer lend out deposits. Loans are created first. Deposits come later. When you take out a mortgage, the bank does not take money from a vault. It simply writes new money into your account. That money did not exist before. It comes into existence the moment you accept the debt. The bank only checks whether it has enough capital to cover the risk if you fail to repay. That is why, in the modern system, more than 90% of all money in circulation is not central bank money or physical cash. It is money created by banks out of nothing. Now think about this. The balance you see in your checking account is not the same as central bank money. It is bank-created credit money, born as debt. As loans grow, the money supply expands. When borrowers fail to repay and banks cannot roll over debts, the system begins to unravel. That is why every financial crisis is, at its core, a crisis of trust. This design produces three inevitable consequences. First, inflation. As the same base money is endlessly converted into new loans, the value of each unit erodes. Prices rise not only because of supply and demand, but because money itself is continually diluted. Second, permanent debt. Since money enters the system only as debt, the total amount owed is always greater than the amount of money that exists. Interest ensures that this gap can never fully close. Someone must always fall into default. Third, concentration of power. Banks collect interest on money that was never truly theirs. Governments use this system to fund wars, bailouts, and social spending. And while asset owners grow richer through inflation, the purchasing power of wage earners steadily collapses. When the system breaks down, the illusion becomes visible. This happened during the Great Depression. Banks issued credit far beyond their reserves and inflated the stock market bubble. When panic erupted and people rushed to withdraw their money, they discovered the truth. The money was not there. Thousands of banks collapsed. The same pattern repeated in 2008, this time through the housing market. Mortgages had been issued far beyond what the system could sustain. As defaults spread, the system approached collapse. Once again, governments intervened. Central banks injected trillions of dollars to save the structure, because modern economies depend on the continuation of the illusion. On the global scale, the pattern is the same. The United States has no reserve requirement. In Europe, the United Kingdom, and Australia, reserve ratios are symbolic or effectively non-existent. Everything rests on Basel regulations. Even in developing countries where reserve requirements still exist, the ultimate framework is still Basel. Wherever you live, the true foundation of money creation is not the deposits in a vault, but the rules written in Basel, Switzerland. Now comes a truth you may not like. The system does not want you to be debt-free. If tomorrow everyone repaid all their debts, the money supply would collapse. Banks could not lend. The economy would grind to a halt. This illusion survives only as long as you continue to borrow, to spend, and to believe that the digits on your screen are real. Returning to the beginning of the story, the brilliant scheme invented by medieval goldsmiths now forms the backbone of modern finance. The dangers have always remained: the bank panics of the 19th century, the Great Depression of the 20th, the global financial crisis of the 21st. Each one reveals how castles built on trust collapse when that trust disappears. And every time, the response is the same. Patch the system, preserve the illusion, expand it further, and move forward as if nothing happened. So what is the final conclusion? First, money is not real wealth. Real wealth is not the numbers on a screen, but knowledge, skills, land, and resources, assets that retain value when paper promises fail. Second, debt is never neutral. It is the foundation of a system designed for lenders, states, and asset holders, not for you. Third, inflation is not an accident. It is engineered into the system. To merely maintain your position, you must run faster every year. Is this inevitable? No, but it requires you to rethink what money truly is. The cash you believe protects you in a bank will not save you. Blind trust in the system will not make you free. Building real wealth outside the debt cycle is the only path to financial independence. The medieval goldsmiths, the 19th century bank panics, the Great Depression, the housing bubble of the 21st century. All are reflections of the same story. Impossible promises and a public that believes until reality becomes visible. And the truth is this: the story is not over. Every crisis you have witnessed is not proof that the system rests on gold, productivity, or anything physical, but on trust. And trust is the easiest thing in the world to lose. The next time you look at your bank balance, remember this: most of what you see exists only on paper. If you understand the trick, you will understand how to protect yourself. If you ignore it, the house will always win. Money is not a reality, it is a belief, and those who do not know which belief they are indebted to will pay its price for a lifetime. If this video changed the way you look at money, then you are in the right place. Subscribe.